Tesla was up 1% in the last 5 days. TSLY was up 2.27% in the last 5 days. So again, it's no surprise that my TSLY fund is also up, but it's up just over 3%. So what we're going to do in this video, we're going to go through all the projected yield, all these kind of good things. We're going to look at the moves that I made. We're also going to check the charts to see what's going on with Tesla and see where we think it's going to end up next week. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. So this series is all about how we can create passive income while trading or mimicking the TSLY yieldmax fund by creating our own synthetic option. So far we've done this now for 16 weeks and Tesla has been down. So I started in this arrow over here and Tesla has just been going all the way down and it's kind of evened itself out slightly. But we've had one earnings that's been horrible. They've not been hitting the demand of all their cars, all these kind of good things. And again, if we have a look at TSLY over the last, 6 months or so, it's down 43%. And, it's roughly, we're down around 34%. So again, this isn't anything to do with the strategy. It's to do with the underlying that we're trying to generate passive income from. And Tesla hasn't been very kind to us. So if we did this like on Coiny or Coinbase or Coiny, which is the yieldmax equivalent, we would be making so much more money. And also this fund will also be up as well. So again, I just want to set that context in terms of it's not the strategy. The strategy does have its limitations, but it's designed to make all passive income. So just so we can have a look at terms of where we are, we have collected $6,386 to date. We've been going for around, I think it's 113 days. We started on the 12th of December. We're now on the 13th of April. So the projected daily dividend yield that I've been collecting is $56 a day. Now I spend about 10 minutes a week doing this, right? And if you guys want to learn how to do this, again, you can either check out my other videos or join my program where I teach all of this, so how you can replicate this with a smaller amount of money using different underlyings and smaller underlying stocks. But I'm generating $56 a day just doing 10 minutes work a week. Yes, my portfolio is down, and that is to be expected because of the underlying, but it's still paying me. I'm still creating cash flow. So the projected yearly dividend is $20,569, where with the starting balance of $30 is a 69% yield on my cost, which again, tell me a dividend that's going to get you a 69% yield. And again, if you guys say Coiny and Nvidia and etc., then that's fine. I get that because they're paying nearly 100% dividend yields currently because of how well that they are performing. But so if we have a look at what happened last week we sold the 170 call for $244, which was the estimate that we had here. And with Tesla trading at 171.05, so I was in the money on my call. So I did buy it back for $149, which was a $94 profit, which again, a realized profit that we booked in here in week 15. And the 244, the delta between that, so the 150 is effectively in the next week's option at $485 that I sold. So, because I could have paid myself $244, but I decided to only pay myself $94 because I knew that the 150 that I paid back to buy back this option is sitting in the 484, which is a yield of 2.11%, which is the third highest yield, or if you ignore this one, it's the third highest yield of the week because week 15's yield is inside week 16. And so this is the first time I've actually rolled the option without not rolling the synthetic, but we'll go on to the synthetic shortly. So what we did, we rolled it at the same price with Tesla trading at 171.05, and we netted $484, which is what our estimate is for week 16. So if Tesla drops down below 170, and if I buy it back or roll it on the Friday, I should capture majority of that 484. So either way, I'm making that 484 one way or the other, whether it moves into week 17 or I do it in week 16. I could pay myself that 150 now, but I just decided to leave it in the inside week 16. So that again brings down that projected yield, because I didn't collect enough, down to 69%, where I think we're at 71, 72, I think, last week. So again, it's dropped slightly, but the good news is that I'll be paying myself the synthetic. So if you think about it here, we got the 167.50 synthetic with a covered call at 170. So what is that? That is $2.50. So it's $250 in appreciation of the stock through the synthetic. That still also needs to get added in here, assuming that, you know, Tesla stays above a 170 at expiration. So this synthetic ends on the 19th, where I've got the 19th. So I'll have to redo the synthetic anyway. So my best case scenario here is that Tesla stays around the 170 mark, or just above the 170, for me to realize the synthetic growth and also the covered call growth as well. So hopefully next week should be a good week, and yeah, I can't really complain in terms of where we currently are. So again, we are 24% down. If we did reinvest the dividends, I'm not reinvesting the dividends. I've taken the money out. So therefore, that is a 34% decline in terms of where we are to date. So if we have a look at, again, nearly a 70% yield, so what, around 18 months, something like that, probably a bit shorter, I would have made $30,000 on this, and therefore I would have paid myself back, and whatever's remaining inside this account would just be, you know, play money to me. So if we just have a quick look at where Tesla is in terms of the chart, we looked at the longer term chart here, where we're not even going to go into that, but if we just look at the short term now, so we've got our synthetic here at the 162.50, which again was at last week's pivot, and the covered call is sitting at the 170 mark, which again is above the current pivot price, which is what we want to see. So again, the estimated pivot is here. Again, it's at what, 172 odd. So again, we're not that far away. Hopefully it just stables around here and just stays between there for the coming week. You can see here that we hit the pivot inside the first day, which again is what you expect to see, and it stayed between the last pivot and this pivot, so it stayed within that range for the whole. We do have earnings coming on the 23rd, so which is the next week. So my roll that I do on the Friday should, in theory, be quite a juicy roll, because premiums will be juiced up for earnings. We'll talk about earnings next week and what we expect to see, what will happen. But again, that's where we could again capture more and more premium, because of the implied volatility increasing. And Tesla's earnings is a very good time to be selling options, because that is where you can again get some pretty decent gains. If we have a look what we did last time when earnings were there, you know, we did $398 on a down market as well when we actually did this. So even though it looks quite low, it was quite inflated premiums for, you know, the Tesla was dropping like, yeah, wherever it's gone, here we go. It was like during this space here. So if you think about it, Tesla went all the way from here to here, and yet we were still able to capture for $400. And you can see that here. Well, this was quite interesting is we started at 553. Again, progressively keeps getting lower and lower and lower. And again, this one here, when Tesla tanked, we were struggling to make any more than 240, went back up. Again, the synthetics helped here in terms of taking some of these gains. And then we've got two added together there. But again, this is what we're trying to do. We're trying to trail this. Even though Tesla is down 60 odd percent, you know, we've still made whatever it was, 21, 30 odd percent of our total initial capital. So we will get there. the more Tesla goes up, the quicker it'll take for us to get there. The more it stays flat, which is also not that bad for us in terms of preserving capital. But if it continues to go down, again, as long as I've got enough margin to place the synthetic, which is around $6,000 to go place a synthetic call, which is what we have over here. This is costing me about $6,000 in margin to handle 100 shares. So if you did 100 shares at the current price, it'd be 17 grand. So this is why this strategy seems to work. So again, I just want to play this out. Once we get to the 30K back, then the goal is to be able to do this again with house money, and then we'll just be taking time. So again, it does take time. I could put 2 on to make this quicker, right? So even though I've got just 23,000, it's 6,000 for each contract, I could put 2 contracts on, which, if you actually think about it, I think this is probably how you would do it, but let's just try it anyway. You know, just put that as a percentage. That's saying now make 137%. So it would take me less than a year to make my 30 grand back. So again, I could do that, but I'm choosing not to. Now that I play out the numbers, that's actually quite attractive. So I might just put 2 contracts on instead to be able to do this quicker, because the quicker I can get the 30K back, the quicker I can start then going back to 1 contract and playing with house money. So again, this is the goal here. The goal here is to get this projected yield to 100% as quick as we possibly can, to then be able to then start playing with house money. So again, I will get there. I could probably work out how long it'll take me to get there. I might do that in years and months and stuff like that based on the current run rate on average. And then we can see what we can do from there. So, I really hope you've enjoyed this video. Please like, please subscribe, and I shall see you guys in the next video.